I do have the top of the hour, so I suppose we better get rolling. I mean, we could probably spend more time on this fun activity, but for those of you logging in, we've been starting out the webinar by asking you to come up with a theme song for 2020 and enter it into the Q&A feed, and these are just awesome responses. The one that I would enter if I had the ability to enter it right now is "Don't Stand So Close to Me" by the Police.
That's a great one.
So yes, exactly. So anyway, we are going to close that up here, and then we can get started with our webinar. So welcome everyone for joining on behalf of TCI Business Capital. I certainly thank you. But yeah, it was really fun to get started with that question. So anyway, we have, oops, let me get this advanced here. I'm having trouble, of course, starting off with having trouble with slides. That's just typical, right, of 2020. But we're not here to talk about 2020. We're here to talk about planning for 2021. And we have 5 topics to cover in 50 minutes. So we're going to start with strategic planning. We're going to touch on both front office and back office, and then leadership, and then we're going to end with the PPP loan forgiveness. And we're going to save plenty of time for that because we know that that's really a hot topic on today's call and today's. So my name is Sherry Tischer. I'm with TCI Business Capital. We provide financing solutions for startups, small and mid-sized staffing companies around the nation. And I just joined TCI at the beginning of this year, but prior to my work with TCI, I spent 15 years on the front lines of the staffing industry, managing branches and operations, and then selling and recruiting. So I certainly have a passion for the industry. Joining me today are Amy Bingham and Jerry Grady. Amy Bingham, too, started out on the front lines, working hands-on in the industry for many years, and then about 13 years ago, started her own consulting business where she now supports owners and leaders and helps them grow their businesses. Jerry has 35 years in the public accounting industry, which undoubtedly makes him an expert in that space. He not only is a managing director for UHY Advisors, but he's the chairperson for their US staffing practice. We do have everyone muted today, so we do ask that if you have a question or a comment or suggestion, to enter it into the Q&A feed, and we'll be checking that throughout the 50 minutes so we can be sure to answer all of your questions. And at this point, I'm going to turn it over to Amy to get us started on our first topic.
All right, thank you, Sherry. So I am going to be talking fast, rapid fire here, because we know from your questions that you really want a lot of information on PPP. And I know we have a lot of CFOs on today's call. But it is that time, right? It's strategic planning season. And my preference in working with my clients, primarily small to mid-sized firms, is to keep that a simple process. Some of you are probably using the entrepreneurial operating system model. If you're not, Google EOS and you'll learn more about it. But my process is very similar. It starts really 5 steps. Just start with a 3-year budget. You can do a 5-year budget if you would like, although I think with technology today, things are changing so rapidly that it's likely that your plan may be obsolete. Your number may have changed radically, hopefully for the better. So 3 years is a good gauge. In terms of planning what you're going to do, right? Focus on 2021. 2 or 3 key initiatives is probably enough for the company, particularly if they're larger, like revamping your website or starting a programmatic advertising campaign, really getting your marketing and social media and lead generation machine working for you. Those are big initiatives. So that's why I say 2 to 3. And then steps 3, 4, and 5 are really about, this is where the rubber meets the road. It's really about implementation. And Harvard Business Review tells us that 70% of strategy is never implemented. And I know that. Sherry, you probably remember that too from our days at Spirion years ago. Mm-hmm. Nothing against Spirion. This is a very common scenario. Leaders get into a room, sit around the conference table, do a lot of brainstorming, no shortage of great ideas, and we come up with great ideas in terms of strategy and even key initiatives, but then everybody leaves the room and goes back to their day job and nothing gets done. So it's easy to see how that would happen. I recommend you use project management methodology, and that is really about, just classic project management work. Tasks, what has to happen to make the key initiative come to life? Tasks, who's going to own it, and what are the deadlines for each task? Assign somebody in the organization to project manage it. That might be the owner, it could be a COO, it could be an external resource, it could be somebody on staff who volunteers to raise their hand, but that person's job is to hold routine status calls to ensure that people are meeting the deadlines and work is getting done. That's how our strategy gets implemented, through project management methodology. So 5 simple steps. No need to do a 25-page strategic plan, and perhaps if you're a very large organization, you may want to go a little bit further, but keep it simple. That's what I recommend. And Sherry, you might have to advance the slide for me because I'm having trouble too. Okay, tip number 2, improving sales and recruiting processes. And very, very high level here. A lot of you have compensation planning on the mind. That's part of the strategic planning exercise we go through every year. So just some general guidelines as you're entering this, or if you're contemplating changing your comp plan, understand that people are going to behave the way their comp plan is written, no matter what we say. So if we instruct them to go sell differently or sell in another vertical that they're not going to be compensated for example, throw leads over the fence to another division, they're not, the bottom line is they're going to march to the drum of their comp plan. So just recognize that. That's why it's so important to get this right. Even small changes can really be disastrous. I worked with an IT firm a number of years ago that just made a small tweak in their sales comp plan and declined on a year where IT, the vertical, the sector, was growing double digits. They had a revenue decline. Then they had massive turnover. So think through every change you're going to make with your comp plan. And don't forget, it's about more than just people's commission, right? You might want to set some quarterly MBOs, maybe 3 objectives that you can either weight equally or maybe weight one heavier than the other. What behavior are you trying to drive? What is it you're trying to get done? That's what you want to think through. And then last but not least, a huge headline here. I have seen so many comp plans where the plan is just far too rich. So you really should be looking at this through a financial modeling process where you're looking at the benchmarks and saying, what can our business afford? What % of our gross profit can we allocate to the sales organization, to the recruiting organization, to the marketing organization? So these are very important benchmarks to know, and to start with that financial modeling to make sure that you're not in a situation where you're overpaying people. I have seen that so often, and it's certainly really hard to go back and take money away when you're adjusting a comp plan the following year. So try to get it right from the outset and get some help if you need it. Sherry, I think you got the honors. There we go. Okay, so in the recruiting world and sales world, we all know, we've all heard about the digitization of staffing. It is happening at lightning speed. The pandemic only sped that up. So you really have to look at your tech stack. This should, I would recommend this be a key initiative for everybody in 2021. What does our tech stack look like? Is it simplifying our recruiting process? Are we automating redundant tasks? Are we making it as easy as possible to get people into jobs? And there are a lot of resources in the industry that are very heavily focused on this right now. But what we should do is look at, again, begin with the end in mind. Our tech stack should increase revenue and fill rates. That's what it should do. So Talent Tech Labs is a good resource. They have a technologies dashboard. Many of you have probably seen. You need a magnifying glass to actually read all of the providers in each of those technology categories. And then there are industry consultants, and then there's a free resource here I've listed, softwareadvice.com, that one of my clients has used. So then from that, you know, it's what's our roadmap? And it should be, you should integrate what they're calling now predictive analytics. I am not an expert in this space, but this is based using AI based on to guide a prospect based on what they click on, what to show them next. So there's a lot of this work around using data to replace intuition in the sales process. So look at that as well. And then bottom line, I think most of us are going to end up in some kind of a hybrid model when we come out of the pandemic, but people will continue to work remotely. So make it easy for your team to do that, for your recruiters and your sales team. Make sure they're set up for success with the right technology, audio, video, hardware, meeting platforms, Zoom, Teams, etc., so that they can onboard candidates quickly and onboard clients quickly. All right, when you're evaluating AI technologies, again, look at the problem you're trying to solve. I've had a lot of clients get bright, shiny object syndrome and overbuy recruiting technologies, and none of them are utilized, or they're not utilized effectively. They're not seeing any return. So what is it you're trying to solve? And look in that category for the technologies available. Ask suppliers for data. You want to make sure you're going to get a return. Use these KPIs here, you know, your revenue trend. Does your tool drive more revenue from our organization? Does it drive more applicant traffic? Can I fill jobs more quickly? What about on the sales side? Is it going to automate lead generation for me? Is it going to help me convert leads to paying customers? Those are all really important things to ask. And then absolutely talk to other staffing firms that they're utilizing this technology. Don't neglect that step. It's kind of like getting references on a candidate. You'll find out the real story when you talk to other staffing firms using the platform. You can also post on, if you're an ASA member, post on ASA Central. I think there's a post going on right now about this. So that when you're, again, just avoid this is a really cool product, let me be oversold and let me buy it and go all in, when it doesn't integrate with your strategy or the problem you're trying to solve.
Okay, back office considerations. Back office can mean a lot of things to different industries. So for the sake of our conversation today, I just highlighted these 4 categories to touch on: payroll processing and staffing software, and then financial and HR legal compliance. And you guys all know the benefits of a well-run back office. I mean, not only does it help make your front office function properly, which in turn supports your candidates and your clients, but it can save time and money. It can improve cash flow and in operations in multiple ways. So a question that I would ask of you is, what's your utilization rate? And by that, I mean, you know, back office considerations doesn't always necessarily mean making a massive change in your system or your solution. It could mean taking a closer look at your existing software or your existing vendors, and are you fully utilizing the offerings and the services that they have available. For example, we do a lot of work with Coates staffing software. We partner with them on a number of mutual clients. And I had a client recently who didn't realize some of the features that Coates had available. He didn't realize that he could run his payroll directly through Coates system as well as his front office. I had another client who didn't realize that they had a fairly new scheduling feature. And so for healthcare staffing companies, or when events finally get back up and running, you know, that scheduling feature is a great feature that's built into a lot of staffing software, and you may not know that it exists. So I would encourage you to take a look at what you currently have in place to see if it's being underutilized. looking specifically at payroll processing and staffing software, let's say that you do decide you want to make a change or investigate making a change. A lot of these things are similar to what Amy just addressed with the front office. What's the business problem I need to address? Is it a situation where you're running multiple software solutions and you want to look for, say, a staffing software where you can run your whole business on one interface? Or with COVID and having to do a lot more work remotely, are there concerns with data security? And do you need to address a problem there? So where is that gap or that leak or that issue, that you're having? Then assemble your team or your decision maker. And I know this sounds simple, but back in the day with Spherion, we went through multiple software upgrades or changes, and other staffing companies I've worked with too. And if you don't have the right decision making team in place, whether it's one person or 5 people or 10 people, it can make a huge difference. Develop a feature comparison spreadsheet. One resource is to go to Capterra and look at their template. It's a great jumping off point to at least get started with the comparison spreadsheet, and then gather information. This is the same thing Amy alluded to here with using softwareadvice.com. That's actually who I used when I did my research for TCI, and I was looking at payroll processing and staffing software. I went to Software Advice and got great information there. With my spreadsheet, I think I started with about 20 different vendors, particularly with payroll processing, because there are hundreds of software providers out there. But I started with comparing 20. And then from there, after I gathered information and I narrowed down, I think 4 or 5 that I actually went into full-blown demos with. And if you ask the experts, they will say, if you start looking at demos of more than 3 to 5 software companies, you're going to end up getting into analysis paralysis, I think is a term that's often used. So you don't want too much information. Sometimes, that's too much is not always better. But when you're analyzing this information and making this decision, not only do demos, but if the company offers sandboxing where you can really do some practice scenarios and testing, take them up on that feature. And then here, I would definitely ask these vendors for references. For example, when I was analyzing payroll processing companies, one of the first questions I asked is, do you currently have clients in the staffing space? And can I get a list of references from you? And it was interesting because out of the 20 that I started with, 2 gave me staffing company references immediately. The others either drug their feet or they never even came up with references for me of businesses or business that they do in the staffing industry. So I would certainly make that part of your process. And then finally, create an implementation and change management plan. It's amazing how there's this natural resistance to change. People need clear communication and they need to understand the why. I know when we went through our software changes with the staffing companies I worked with, unless people on the front lines and in the field understood clearly why we were making this change and how it would benefit them and save them time and make things easier or be better for the candidate, you're not going to make them change their behavior. So that's key in rolling out any software change. With financial risk and HR legal compliance, you have to think of your cash on hand. You need cash on hand for payroll for 30 or upwards of 90 days. And what's your best solution? You may be self-funding. You may have a bank line of credit or a loan, and those are all great. But it's also important to consider the option of payroll funding or accounts receivable financing. If you work with a partner who's got great customer service, is professional with your clients and with your internal associates, has short terms, they don't lock you into long 12-month or 24-month contract terms, you know, it can be a really great solution for you. And then with HR and legal compliance, you know, are you doing it in-house or are you outsourcing it? Can an existing vendor help support these functions? For example, there are a lot of insurance companies, funding companies. We actually do this where we provide a complimentary HR on-demand service for all of our staffing clients. So ask your insurance companies, your payroll processing provider, your funding provider, if they offer some of these additional services as part of their service. None of these things that we've talked about so far would be, I guess, you know, executed or implemented without good leadership. So I'll pass it back to Amy to talk about leadership.
Thanks, Sherry. And just to piggyback on what you said, that change management, I mean, people will not change their behavior. I've seen it over and over again, especially with recruiters. If there's a new workflow implemented, if they don't understand why we're doing it, they'll default to their old way. And that's when you, as the owner or executive, says, we bought this tool and it's not being used, and it drives people crazy. So it is hard to get people to change behavior. They have to buy in. That's huge. And also that compliance piece that you just talked about, Sherry, is really, really important too. So you have to, there's a lot of moving parts. There always have been in this industry, but again, technology has just really made that much more complex. So make sure you have good partners. So let's talk leadership. I think I'm going to put up a poll question now for you. So get you involved in who is responsible? Who is responsible for creating a good company culture? Everybody weigh in. I have opened the poll. All right. Just let it run here. We got a lot of people weighing in. So far, managers and executive team has the lead, followed closely by the CEO. Not so closely now, the spread is wider. I feel like we're doing the election here. Dare I bring that up? No. You'll edit that out, right, Sherry?
Yes.
Okay, I'm gonna go ahead and close it. 58% of you are saying the managers and the executive team, 42% say the CEO, and 0% say HR. Well, and let me just share the results so you can just see that really quickly. And I'm going to talk now. In the next few slides, I'm going to give you some data, because there aren't many organizations that have done surveys with employees post-pandemic yet. So when this survey from CHG Healthcare came out, I saw it in the Staffing Industry Analyst newsletter a couple of weeks ago. It really intrigued me. So 61%, when asked the same question we just asked you, 61% said yes, managers and executive team really own the culture. 23% said the CEO, and 3% say HR. So similar to your results, but here's the takeaway. The bottom line is you as the leader set the tone for the culture, and if you're not talking about it, then your field team isn't going to go implement it. But ultimately, at the end of the day, it's in the trenches, it's about the manager. And for the manager, the branch manager or operations manager perhaps, for that lower level management tier, it's about their next level manager. These folks are setting the culture. So if you want them all to march to the same drum, you as the executive need to keep it alive and talking about it. And the good news is, most people have done a good job with that. This, since the pandemic hit, it's forced us all to work differently. Go ahead and advance the slide, Sherry. So yeah, so 54, so 2/3, right, or almost 3/4 say that culture's actually improved during the pandemic, which is great. And the people that said that it improved said they cited increased transparency and communication for that. So I feel like my boss is giving me authentic information, telling me where things stand, even if it's not news I'm going to want to hear, being very transparent with me. and communicating more frequently. And we've all said over and over again, you almost can't over communicate, particularly in this industry. So that's one of the key takeaways. A lot of my clients have done a great job here, being very transparent, setting up remote work management practices that have been very, very effective. So here we have some data that says that we've done a good job, which I think is great. Next slide. And what do they say contributes to a good culture? Workplace environment. These are in order of importance. Workplace environment first. Help me grow my career. So career development is behind that. Access to leadership, very important. Transparent. So there's your leadership access and transparency right there. And then why the job has meaning is the last one. I don't know. I would think that would rank higher. People want to do work that has meaning, but if we're looking at the top 5 here, these are the contributors. So great things to think about as you're looking at what you're going to do from a culture perspective next year. Next. And so what is then the 2021 formula? Well, as I was thinking this through, I always recommend that everybody's involved in strategic and key initiatives. So it goes back to what Sherry was saying earlier about change management. People will own what they help build. So if they got a vote in what the company strategy was for 2021, or at the very least understood it, and then volunteered to maybe take on some of the tasks, they're going to make that happen. So for you as the senior leader, that's what you want to do. You don't want to develop the strategy with key people on your team and then roll it out to the team. You want them involved. So get them involved. Model an inclusive culture. Over communicate. You really can't over communicate. If you said something on a conference call or on a Teams call, put it in writing, an email. Make sure it gets funneled down all the way down to the folks that really need the information, doesn't get stuck somewhere in that communication funnel. Invest in talent development. That is recruiter training, sales training, so front office training, and continuous learning. Monthly lunch and learns, conferences, webinar attendance, things like this, anywhere they can learn. You want to put together a plan for helping develop your talent. That's how you retain them, and that's how you create a strong bench to promote people. And then finally, look consistently, be obsessed with how do we automate these redundant tasks? How do we take tasks off the table for our recruiters in particular so they can spend more time interviewing and getting people into jobs? And also for salespeople, we've got to keep that lead gen funnel going. They'll exhaust their target account list at some point, or they'll just get discouraged because they don't have enough warm leads to follow up on. So make sure that you've got a process in place to get lead generation, to automate that as much as you possibly can. And I think now I'm going to hand the baton to Jerry.
Oh,
there we go. Sorry. Thank you. Thanks so much, Amy and Sherry. That was some great stuff. I was just taking some notes down as you guys were talking because there's quite a positive things. And Amy, one thing I'll tell you is one thing we always use on compensation is what Henry Ford said. If you want to change behavior, change compensation and watch what happens.
That's right.
So,
love that.
Yeah, it's a great tool we use all the time here. We're going to be flying through some of this stuff, so please do not hesitate to put questions in, and I'll hit them hard as I can. In addition, I have about 15 questions here that came through, and I'm going to try and address everything as fast as we can. I want to go through some items for you to remember, though, so that as you're going through and filling out your applications, you understand what you're looking at doing. The loan forgiveness calculation does start either with your 8 weeks or 24 weeks or in between that. If you had a loan issued prior to June 5th, you are able to only use the 8 weeks if you choose, but you can also choose the 24-week period if you want to. So I do want to get that out to everybody. because we are seeing a lot of issues where people think it has to be 8 weeks or it has to be, I spent all the money. The best week number to use is 24 weeks. The more dollars that you can put to the cost you spent over that 24-week period, the larger your forgiveness number can be. And I'll explain that in a minute. Payroll costs are cash compensation, health insurance, retirement matches that you may have done, such as 401k matches or profit sharing, and then your unemployment taxes. And there are some local unemployment taxes that do get added in for certain states, but just be cautious of that they're those dollar amounts. Cash compensation, which does include PTO and vacation time. It does include those numbers. The non-payroll accounts that you want to be tracking are your rent, your utilities, and then any interest payments you might be making on covered mortgage obligations and personal property. So if you have interest that you've been paying on your personal property, such as computer systems, or you implemented a new, back office solution and borrowed against it, those interest payments are able to be added as a non-payroll related cost. What I do want everybody to remember is that no more than 40% of the total cost paid can be for non-payroll related cost. Now, let's talk a little bit about our owner salary amounts, because this does add some confusions. The way payroll is done is that it is payroll during the cover period that's either paid or incurred. And so you could be using your last week or your last 2 weeks of payroll. It could be incurred even though it was not paid on that last week for your 24-week. So let's say your last week ended, your 24-week period ended on October 31st. That means because you pay payroll in arrears, the payroll that you actually paid in November can be prorated to include those days that included October. That's one of the areas that we are seeing a lot of people miss, is they're not pulling in incurred payroll that was paid. Also, we've seen some dental and vision policies not being added in to the payroll cost, so please add that. Now, the cap, the overall cap for non-owners is $46,153, which, as we all know, is that you cannot go over $100,000 for any one employee. If you are using the 8-week period, your cap is going to be $15,385. Now, for the owners, they have added some really tight definitions for expenses for compensation. For a C corporation or a S corporation, that owner's salary is limited to 2.5 divided by 12 of their 2019 cash compensation, or a maximum of $20,833. Then you can add in any health and retirement in addition to that cap. So that creates a problem for many S corporations and many C corporations, because you are only allowed to deduct $20,833 over that 24-week period for owners. And an owner has been defined as anybody that owns 5% or more of the stock. If you are self-employed, it's the same calculation, 2.5 divided by 12 of your 2019 Schedule C, or a maximum of $20,833. For a general partner, which I have not seen a lot of partnerships in the staffing industry, but I know there are a few, that is limited to 2.5 divided by 12 of your 2019 net earnings from self-employment multiplied by 0.9235. And I'll explain that calculation, because if you are an LLC and you are filing as a partnership or a 1065, you do have to take note of this. So what you're going to do is you're going to take your net earnings from your K1 from 2019. You're going to multiply that by 2.5, because that was the dollar amount that you were able to get on payroll. You divide that by 12, and you're going to multiply it by the FICA rate of 0.9235, because you're not able to utilize FICA. And so that's why they've done it that way. So as you see, those owner salary amounts are pretty important to understand and have laid out, because that is one of the key areas that the bankers will be looking at. Are you able to include short-term and long-term disability plan costs in the insurance consideration for forgiveness? And as we read it, it's not documented, but we are including that in there, so long as the company is paying that and it's not a non-discriminatory amount. So if you are paying for those insurance policies for everybody, that will be considered a health insurance number. We have taken the approach that if it is not listed and is not specifically documented, we're going a little more on the aggressive side, because I would rather have them argue it that it doesn't belong there than to find out it belonged there, but no one put it in there. So those are the types of questions that you want to keep asking as you're working through these numbers. Now,
there's
go
another
ahead.
question in there.
No, okay, is the employer match portion of FICA Medicare? And the answer is no. It is only the unemployment taxes that are able to go into that calculation. They specifically excluded the FICA and Medicare. So forgiveness, and the reason I go over the payroll cost, the non-payroll cost, and the owner's salary is because our forgiveness actually is done on a two-factor reduction process. The first factor is that if any employer reduces salaries by more than 25%, that becomes part of the calculation. Now, in staffing firms, we all know that recruiters and salespeople get compensation that is sometimes incentive-based. So long as you do not remove that incentive-based formula and calculation, then a recruiter's salary or a salesperson's salary who went down by more than 25% would not be a reduction, because the way they've done it is they've said you start at your base salary, and as long as someone's base salary has not been reduced, therefore we're not going to put that into this calculation. It's not going to be used to reduce forgiveness. That same thought process also goes to the light industrial arena, because overtime was a big issue everybody was concerned about. So what you have to do is you look at your pay rate for anybody you're paying on an hourly rate. You look at the pay rate, and so long as that pay rate does not go down by more than 25%, then their reduction in pay would not be hurt. We saw a lot of light industrial employers who are down 50% in wages on multiple employees without any reduction in this one area, because they did not reduce pay rate. It's just overtime has been reduced substantially. So that is one thing to note. The second forgiveness area they start with is that we look at the employer needs to be at or above the same FTE number, comparing it to either February 15th, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. This is where the trick comes in, because this is where you get to pick which one you would like to choose. So our covered period, we know, is the 24-week period. That 24-week period starts the day you got the loan, or if you chose the alternative payroll, it starts the very first payroll period after receiving your loan and goes for 24 weeks. You look at what is your average FTE over that 24-week period, and then choose to compare that to the lower of these two periods, whether it's the February 15th, 19 to June 30th, or the January 1st to February 29th, 2020. So you do have the ability to take the lower of those two periods and compare it to your FTE. We have seen that the first 2 months of the year were actually lower than those other 4 periods back in 2019, but there's quite a few clients that we've looked at where when they ran their FTE calculation, because remember, FTE calculation is based on a 40-hour work week, not the typical 32-hour ACA work week. So that's something important to remember. But the 2019, we have seen some staffing firms who were not really high up at that time period. And the first 2 months of this year, they were really on track to do some great things. So we just want to make sure that you do understand that. I do want to talk a little bit about the full-time equivalent, because there is still a lot of what I call, discussion that is creating issues. And I will get to the question that you just put out there in a second. Our full-term equivalent, as I stated, does work on a 40-hour work week. They also have stated in the actual law that you use the average of their work hours. So in a 24 work period, there is 960 hours available to work. We know in all industries, there are people who may work 60 hours 1 week, and then the next week they might only work 30 hours. Because the law is stating it is an average hours worked by the employee, we are suggesting you take the overall hours that somebody works during that 24-week period and divide that by 960 hours. And if that comes to 40 hours or more, then you know that you have a 1 FTE, because that means they were averaging more than 40 hours per week. If somebody is working less than 40 hours on average per week in that calculation, they will be considered a reduction in your FTE. The FTE can be done 2 different ways. Everyone above 40 can be a 1, and everybody under 40 can be a 0.5. We call that the simplified method. However, this is a math game. We would want you to at least look at the math and take it to the 0.1, because they do allow you to go to a 0.5, 0.6, 0.7, but it has to be consistent. So whatever method you use for your measurement period is the same method you have to use for your covered period. So if you decide you're going to go and do the full math and round things to the 0.1 on your FTE, then you got to make sure that your measurement period was done the same way. The larger the number of employees, we are seeing that mathematically the 0.1 or 0.2, that 1/10 decimal seems to give some people maybe 2 or 3 more FTEs compared to just using the 0.5 and the 1. So you do have to go through the math on that. Regarding comp plans, what percentages of gross margin dollars have you seen paid out for? Amy, and Amy, you get to answer those 3 questions.
So there'll be variances depending on what your company's strategy is and investments you may intentionally make to achieve that strategy. But general guidelines, 12 to 16 or so % for the recruiting organization, 15 to 20% for the sales organization, and that's inclusive of base salary, commission, any commissions, bonuses, insurances. That's all in for the sales team.
Thanks, Amy.
And the recruiting team.
Yep. And I think it's important to note, as Amy talks about that, as long as those comp plans are still in place, you do have the ability, again, because if you're not hitting the same dollar amounts that they were hitting before, that's not a reduction in pay. So just stay focused on that, because the payroll systems and the payroll reports we've seen coming out of ADP, Paycor, and a couple of the Paychecks and a couple of the other big players, they are actually showing employees being paid less than 25% or getting a 25% reduction and putting them into the wrong category. So do not just accept your payroll reports from your providers. You need to do some thinking on that. Next question I want to get into is on how do you avoid FTE reductions? Those FTE reductions are done by two methods. You either have the exceptions, which the employees can have, or they're going to have what's called the safe harbor method, which unfortunately is an all or nothing scenario. The FTE reduction, anybody that voluntarily quits and walks out of your organization is considered a reduction in your measurement period FTE. So let's say your measurement period had 100 employees and you ended up having 3 people that resigned and voluntarily quit. Those numbers get removed from the 100. So now your measurement period is 97. You do have to document that. You got to have your file laid out properly, and you would definitely want a resignation letter in there. In addition, anybody that's fired for cause also is removed on that number for your measurement period. We also have taken a very aggressive approach that if you had a temp who was working for you during your covered period and they ended up being hired full-time by your client, in our mind, they voluntarily quit because they went to your client, which is another position, and so they voluntarily resigned from your organization, and we are reducing the measurement period FTE number. I have seen that in a multitude of organizations in the last 30 days, where as people are looking at the people who got hired by their clients, that has been a factor, and we've used it to reduce that FTE. You can also, if you offer, let me take a step back on there, sorry. If I have a position that you are trying to fill, and that is one of the FTE positions that was there during your measurement period, and you are constantly unable to fill it, that is considered a reduction in the measurement period. However, there's one thing you need to do. You need to be documenting that position, that nobody wants to take it, they've refused it, and you have to have that documentation. We have seen this extremely heavily in the LI industry, where they will have a LI position that was there in February and March. The place got shut down. They get reopened. and nobody wants to come back to work because they were making more on unemployment than they were making at their position. And so they refused to come back. Two things do have to happen in that area is that, one, you got to document the day you talk to them, and you got to document that they did refuse it. And you are also supposed to call the unemployment agency and let them know. We are hearing from the SBA that they may do an inquiry into the unemployment agency to see if you turned them in. So I'm leaving that out there for you. That's what we call risk versus reward. Also, if a person's hours were reduced and you offered to restore that reduction in hours, but the employee declined that hour increase, that is also another way that you can reduce your FTE from your measurement period. But that involves the fact that your offer has to be for the same amount of hours, the same amount of pay. It has to be rejected by the employee, and you have to maintain in your records that they have been offered and rejected. We've been encouraging the recruiters and or customer service reps to make sure they document that in the ATS systems, so that when they're called for that data, they quickly have it. Those are the only three methods that you are able to reduce your FTE number on your measurement period. Safe harbor method, two different safe harbors, and I'm starting to see a lot more clients and us taking a position on safe harbor 1. Safe harbor 1 is very specific. The borrower is able to document that it's unable to operate during the covered period at the same level of business activity as before February 15th due to compliance with requirements established by, the state health services, the CDC, or OSHA. Basically meaning just about every state was shut down sometime in May or March, April, and May. And if your level of business activity is substantially reduced, which they have not defined what substantial is, you do have the ability to use Safe Harbor 1. We have been working with our clients and putting together memos documenting why their numbers are down. Documenting that, yes, they're down 55% in revenue, they're down 45% in job order fills. The reason is because the state was shut down. The companies we worked for still have not gotten back up to speed. Therefore, we have taken a very serious reduction due to those shutdowns. That's what we're looking at now, because now we are seeing a lot of light industrial, certain IT firms, depending on if you were high level or low level IT staffing, even some home healthcare staffing firms were seeing that they were seriously infected over that, the last 6-month period. This is one originally we were not going to be aggressive on, but we've started to take an aggressive approach on it. However, it does involve documenting and getting a memo written by an outside party. This is not something you want to just click and say, "Oh, I automatically did it." You're going to have some analytics for this, because the SBA is going to be looking for some type of memo or some type of analytical report that shows how you got there.
Jerry,
yes.
If I could interrupt for just a minute, I know that we're over time.
Yep.
I don't know, if you have a hard stop or people on the call, if people are wanting to hang on and you still have some things to wrap up, I say we do so, but I guess you're.
Yeah, I can get through the last couple things quickly. Those were the big, and I'm looking at the questions. What I'm going to do now is I'm just going to quickly give people answers to the questions they ask. Because there is, that's part of the problem, is there's a lot to go over here.
Yes.
On the forgiveness calculation, the reason I keep pushing on the 24-week period is your calculation starts with your total expenses paid. So let's say your loan is $500,000. You spent $1 million in that 24-week period, and your payroll numbers are down by 30%. You take $1 million times 70, because that's what your FTE calculation is. That means you had $700,000 of allocable expenses. You compare the 700 to the 500, therefore you get full 100% forgiveness because your loan was less than the expenditures you paid, and you don't even have to worry about safe harbor. That's why we encourage and tell people do the 24-week calculation, because you may be better off doing that than even worrying about the safe harbor. One of the questions on here was about what are some of the PPP loan forgiveness tips. That's one of the key ones. The other one is that I did have a polling question on here that I will pull up real quick because it will determine if we go into it. Oh, wait a minute. There we go. And there we go. So I want to get an idea who's over 2 million and who's under 2 million. And as you guys are answering that, there is a 150-day period to which everything has to be approved. So it's 60 days for the bank to either approve or disapprove your loan. And then it's 90 days for the SBA after that period. So that's one of the most important things to do, is understand the timing and the dates that need to be there, because you have to have this done. The banks and the SBA have to have it done within a certain period of time. And what we're seeing right now is banks are just finding ways to postpone taking your application so that they can keep increasing their 60-day period. Well, interesting. So everybody on this call is pretty much under 70 or under 2 million, with the exception of 6 people. And that's good to know. And the reason I asked that question, for you that are under 2 million, things will be a lot easier than that are over 2 million. Those that are under 2 million, you're most likely going to hit forgiveness pretty heavily, and you're not going to be attacked very heavily by the SBA. You do, however, want to make sure that all your data is accumulated and all your numbers are calculated properly, because pretty much what the bank decides, the SBA appears to be going to rubber stamp that if the bank agrees it should be done. If you're over 2 million, there was a new questionnaire that just went out last week. That questionnaire is very cumbersome. It's asking a lot about liquidity. It's asking a lot about borrowing. But what it's really doing is it's playing Monday morning quarterback, which is not the intent of what the question was that you answered, that said you needed the loan and that you had no other avenues to get any money when you first applied. So just be cautious of that because that was a working product. It is not a set in stone questionnaire yet. For the PPP proceeds to be taxed, if you want to go to the next slide.
Okay.
Oh, hold on, I got to stop sharing. There we go. These are the factors that are impacting a lot of the timing of the forgiveness application. You know, does the borrower need to make business operating decisions that may include FTE reductions? Does the borrower want to get off the PP debt off the book? These are questions of when you want to file. What we are seeing right now, because of this very large increase in COVID-related test and positiveness, we are seeing a lot of clients who are just going to wait till the end of December are now coming back and saying, we're going to get it in. Again, I'm going to reemphasize, that's why you want to look at your 24-week period, because if your 24-week cost structure shows that you are over the limit and you do not have any problems and that you do have full forgiveness without any of the safe harbor laws, and you are over 2 million, I would suggest you wait, because you don't know we don't know what's going to happen. Nobody has any clarification at all on what the SBA is doing on those $2 million loans. Taxing, that's a question everybody is still getting thoughts on. As it stands right now, you are not able to deduct the expenses you paid with any of the money that is forgiven. The loan is not income, but to pay expenses are not deductible. There is no code section that I can point you to. There is no letter ruling that I can point you to. It is what the IRS has come out and stated what they are doing based on a very old law that relates to forgiveness of income. The IRS position is that if you know that you are going to have your loan forgiven, then when you know that, that's the year that those deductions will not be deductible. I know all of you want to know the answer on this, but what I've been telling clients is if we put the application in 2020 and we've stated that we feel we have 100% forgiveness, those expenses would be non-deductible in 2020 because we knew in 2020 those expenses or those loans would be forgiven. That's another reason why many people are pushing to 2021 to file, because if I file in 2021 and the IRS lives up to that thought process, I now postpone the payment of that tax another 15 months. However, the Senate and the House have both added clauses in their Business CARES Acts for their fourth stimulus package that will have that all expenses paid by PPP money will be deductible. I don't think it's going to get through by the end of December, everyone. I don't think anything's getting through by the end of December, but stay on the lookout because we might get lucky and they may actually just agree to disagree and just pass that because it's a very, very big issue. Someone was asking the question here on they got the green light to apply for forgiveness. And pretty much if you are under 2 million or even under $1 million, I recommend if you have the forgiveness and it's 100%, you want to get it off your balance sheet and you just want to move on, I would go ahead and just file and be done with it. You can always extend your tax return to pick up on any of the IRS rulings that might come out after December 31st. If you are over 2 million, and again, as long as you had enough cost to overcompensate for the reduction in your FTEs and you still get forgiveness, I probably would wait until next year so that we have more guidance and more clearance and more idea what the IRS is looking to do. John, I don't have a firm opinion on the 3509 yet. I still need to do a little more research and a little more understanding because there's just too many unanswered questions to really agree or disagree on anything right now. We'll get something out to everybody once we know this, but there's just too many unopened areas that we're all focusing on and not enough answers for everybody. What is the outlook for a second round of stimulus? I truly believe it's going to be coming. I just don't think we're going to see it till January, but I also think it's going to be extremely limited to businesses that truly took a greater than 50% hit in that 6-month period. It's not going to be a free-for-all like it was, the first round. This next round is going to be extremely limited to very, very small businesses and very focused on revenue numbers. And if your revenue didn't dip between a certain dollar amount, you're not going to be able to get it. Will the staffing industry have a different forgiveness standard? And unfortunately, everybody, the answer is no. The ASA did everything humanly possible to make that change, and they could not get it through. But what I like to tell the staffing industry is, and this is my opinion, we did get a big win because you were able to get money to cover your employees while still putting your employees out in the field to collect money. And it is no different than somebody building a product. Our asset is the employee. We are very fortunate that we're going to collect receivables for our employee and also had the PPP money to help us fund that payroll for them as we waited for that receivable to turn. So there is a silver lining in the fact that, yeah, maybe you might have to pay some of that back. Maybe you might have to have some tax dollars paid. But at the end of the day, I truly believe the staffing industry did very well on this. And it really helped keep the industry afloat. Sorry I ran over, Sherry,
No,
but I...
well, I know we've kept everybody over 15 minutes, but it's such good stuff that, you know, it's hard to stop. So, and I think it's really important. But what we will do is we will send out a follow-up email tomorrow to everybody. We'll share the slides. We'll share the recording of the webinar. So then everybody who attended has that. And any unanswered questions we will also address. But we certainly, I want to thank Amy for joining us. So if you have any further questions for her, here's her contact information. Jerry, your contact information here, and then my contact information for any questions related to funding or back office solutions. But thank you all for joining. We appreciate your time today, and let's end 2020 on a good note and go get them in 2022 or 2021. Oh,
2021.
Thanks, everybody.
Thank you. Bye-bye.
Yeah, bye.
Bye.